Well, thank you everybody for joining us for the Ellsworth monthly recap for July 2019. Today is August 6, 2019, and we have a lot to talk about today. Starting after the end of the month, things have gotten a little crazy in the markets. So, basically we'll start off with a little bit of, what's happened the last week or so, a recap of July, how the effects of the last several days, how they've affected portfolios in the markets, and really what our thoughts are moving forward. So let's jump into it with Cam. How about a little recap of what's been going on the last 7 days or so?
Well, unless you've been living under a rock, you know that the market has had a little bit of turmoil the last week. Essentially what happened is the Fed cut interest rates by 25 basis points last week. That was widely expected. Some people thought they might get a little bit more aggressive and go to 50 basis points. So when it did come in at 25, it was considered a little bit of a disappointment. It was also basically baked into the market. The reason the Fed's doing this is because there's a clear sign that the U.S. economy is slowing. We're not in a recession. Things haven't fallen off a cliff, but the economy is slowing because the rest of the world is slowing. And so the Fed took some proactive foresight into making that rate cut.
They kind of call it a little bit of an insurance policy.
A little bit of an insurance policy, yep. Try to create, if there is a recession, they're trying to create a little bit of a softer landing. Fed rate cut. Good to see the Fed being proactive, but as soon as we had that rate cut, we then had President Trump implement another 10% tariff on Chinese goods. The Chinese immediately retaliated by canceling a large agricultural purchase. They also devalued their currency, the yuan. And, it looks like right now we're in a protracted trade fight. I mean, not only are we in a trade fight with the Chinese, but we're also in a currency fight now with the devaluation of the yuan. A lot of people believe today that the Chinese are in this for a protracted fight, and they're looking at this as more of a battle of attrition. Now, that being said, the Chinese economy is being hurt. Their growth has slowed down significantly, but at the end of the day, the Chinese typically take a longer-term approach to these things than we Americans do. We typically like kind of instant gratification, where the Chinese are looking down the road. And we have really two issues. President Trump has an election coming up in 2020. He obviously has a hostile press that will use anything they can against him, whereas President Xi from China has no free press, is basically a dictator, and is not worried about elections. So I think the Chinese real position today is, if they can wait this out, perhaps the Trump administration gets nervous if we get into next year, and we'll be looking to make a better deal for the Chinese. That being said, our president seems to be a man who sticks to his guns. He believes that the economies of both China and the U.S., we need to have more parity. We need to do this for a global solution for years to come, not just for today. And the fact of the matter is that the Chinese do have a lot of unfair labor practices, currency devaluation, manipulation of their markets, stealing of U.S. intellectual property. And for years, presidents have said, we've got to get tough with China, we've got to get tough with China. They've never done anything. So at least this president is sticking to his guns. And I think, the important thing, and I know you're going to touch on it, is we're in this for the long haul when it comes to your investments. And so if the market has you a little bit concerned right now, don't watch it every day, and just remember that we're doing this for today, tomorrow, 10, 15, 20, 30, 40 years down the road. And you got to keep that long-term mind frame when you're investing.
Good update, Cam. I'll add a little bit on the situation. The reality, the volatility this is causing, I think it really kicked in over the weekend, where the Chinese did let their currency fall. Typically, and what we've seen the last several years is they've had to actively keep the currency up to maintain its value. There's a lot of argument out there that if it was a free-floating currency, it would be lower than where it's at today, even with them, allowing it to come down. So the Treasury Secretary is trying to label them as a currency manipulator. There's a lot of debate around that. What is currency manipulation? What they've done or what they did really doesn't fall within the definitions of the IMF or really the U.S. definitions of it. But the reality is they've been propping it up to keep it up at levels where it's been, and they basically just didn't prop it up. It fell below 7, or it went above 7 from a dollar for yuan translation. But that shot was fired across the bow. In the grand scheme of things, you really don't want to have a weak currency. What that has done is obviously strengthen the U.S. currency, and it's puts China in a difficult place. China has some issues going on economically. Their growth is slowing. They carry a lot of debt, and from a strength side, is the U.S. stronger than China? Absolutely. From overall size of the economy, healthy economy, banking system, we're in a pretty good position. And if there ever was a time to press China, you want to do it when we're healthy. You wouldn't want to do it when we're in the middle of a crisis or in the middle of a recession. So if we're going to address these issues, now's the time to do it. The reality, though, is it's kind of like a game of chicken, and a game of chicken has no odds. So we're not trying to position around whether the tariffs are going to result in one scenario or another. Once again, we have to look at the long term. Long term, the U.S. economy is healthy. It's not rip-roaring, but it's not collapsing. We are definitely late stage in the economy. At some point, we are going to see a recession. Yep. We're seeing, just like our last time, we're seeing some signs of late cycle signs. But then again, we're also seeing signs of growth. So we're in a slow growth mode. Earnings.
I think
our last. Yeah, go ahead.
I think we said this last time, but don't they call this the Goldilocks economy? Things are not too hot and things are not too cold. Exactly. They're just kind of right down the middle.
And our last video going into July, we were expecting volatility going through earnings season, which really started mid-July, will run through August. And my thoughts were, we're going to see some volatility because earnings are going to be announced. There's going to be some misses in there. And the reality through earnings season so far, expectations were set below reality. So, we were getting through earnings season pretty well up until early last week when the market hit an all-time high on Monday, and then we had the Fed, then we had the tariffs, and that's really caused the big pullback. So since the end of the month, July 30th, we've seen the Dow basically retraced about 5%. The S&P basically pulled back about 5.5%. So what's happening right now is volatility. We thought volatility would happen. I thought it was going to be because of earnings, but now we have some new factors that have thrown the volatility into play. But longer term, we really want to base our decisions on what's really going on with actual companies themselves, with earnings, and more the general direction of the U.S. economy, which once again, it's not falling off a cliff. We're still growing, be it slower, but the outlook still is not that bad. So what I want to do, I'll jump into how things went for the month of July. July was, call it a mediocre month. We came off June with a pretty strong rebound in the markets after a weak May, strong June. July was fairly flat. The Dow for July was up 0.99%. The S&P 500 up 1.31%. The EAFE, the International Developed Market, down about 1.49%. The emerging markets down 0.95%. And then commodities were up like 0.1%. So through July, on an annual or a year-to-date basis, Dow was up 16.69. The S&P was up 20.24. International markets 12.58. Emerging markets 7.38. Commodities 9.46. So that was as of last Wednesday. From Wednesday till through yesterday, Dow was down, like I said, down about 5%. The S&P down 5.5. So through yesterday, Dow was up 11.72, and the S&P was up 14.8. Emerging markets definitely took it on the chin since last week, down 6.6%. International developed down 3.8, not too bad. Commodities also have taken it on the chin since last week, down 4.6. And one thing with commodities is you get a strong dollar. Commodities are priced in dollars. Dollar strong, that brings down commodity prices. So that's not surprising to see commodities pull back. Still up 4.85 in our portfolios.
But it's interesting though when you look at that now, year to date through where we're sitting today in August. It's definitely the discussion we continue to have. U.S. markets up, rest of the world is basically flat.
Correct.
With emerging even down a little bit. So
emerging markets are basically flat year to date, up 0.75. Developed world, single digits, but not too bad. But it's definitely the U.S. that's driving things, and that's really where we're making money in the equity markets is on the U.S. side. In our growth with income portfolio, we've had commodities as a hedge, so that hasn't, that detracted a little bit last month. We have been sitting on a gold position. Year to date, gold's up 10.4, and since the beginning of the month, last Thursday, it's up 3.44. So that's helped cushion things in the growth with income portfolio, which year to date through July, up 12.47. The month of July was, basically flat. We saw a little pressure in Apple to the downside, which is one of our bigger holdings. So growth with income flattish from last week, from the first through yesterday. We saw about a 3.02% pullback in growth with income compared to the Dow and S&P down 5.5. Dividend yield portfolio for the month, once again up slightly, up like flat. Maybe some accounts maybe slightly negative or less than 1%. So dividend yield was pretty flat last month. End of the month, year to date, up 16.19. And in the dividend yield portfolio, the reality is in there we're looking at big dividend payers. We have two positions in there that continue to feel a little bit of pain with the China issues, Boeing and Caterpillar. So they've detracted from that portfolio through this pullback last week. That dividend yield gave up about 3.1%, still up 12.5% for the year. So dividend yield, because of a couple positions in there, I think is holding up better than expected with the Boeing issues. But then again, you have the Chinese exposure with Boeing and Caterpillar. Price potential year to date through the end of last month, up 20.16%. Actually picked up 2% for the month of July. That was a result of good earnings on several of our holdings. Pullback wise, since last week, down 3.3. So once again, a little more than half what the markets did. So that held up pretty well. Year to date, still up 16.14. Our small cap portfolio, small caps last month up about 2.5%. So small caps continue to do fairly well. Once again, I think that was an earnings story. Through the end of the month, it was a little over 19%. The small caps being more volatile, a little more susceptible to headline news, down 4% since last week. So that all takes us through yesterday. Today, the market opened up 100 points or so. Won't be surprising if we end flat, maybe slightly down. I think the volatility is definitely going to be with us here for a little while. I think the currency issues will blow off in the short term, but we have to expect the ups and downs at least through September, October, just because those, we're in kind of the questionable part of the season.
What do we continue to say is we invest in high quality companies.
Exactly.
High quality companies do well when the market's up. They get hurt less when the market's down. And when the market goes from a bear to a bull market, they recover quicker. And I think your portfolios right there have shown. And they did feel some pain, but they felt less pain in the overall market. And they're up, very strongly year to date.
Quality is key.
Great job.
Quality is key. We don't have a ton of international exposure. We have a little bit, but on the whole, we're definitely below where everybody else is. When you look at diversified portfolios, we have a lot less international exposure. So that's kept us kind of, especially in the pullbacks, allows us to outperform.
But you are an active money manager. So
correct.
As you see a change and maybe a slowdown in the U.S. and a pickup in the other developing countries, we will increase our international exposure.
Yeah, we're if this was 6 years ago, we'd have a lot more international exposure, or 5 years ago, we'd have more international exposure. And a lot of the noise on TV, okay, hey, this is going to cause a big global issues. And the reaction in the market is really what we saw through this whole devaluation situation. Is it affected our, all stocks in general. Chinese stocks got hammered. Mm-hmm. But what we didn't see was really you did have a natural move money into Treasury, so interest rates came down. Part of that was a result of, the Fed cut last week, but also a little bit of a flight to quality, so we saw longer term rates drop. One thing we didn't see was, in the high yield area, credit has kind of held firm. So the fact that credit didn't deteriorate, that's kind of the last canary in the coal mine. When we start to see some deterioration on the credit side, besides just leaning towards quality in our stock exposure, we start to see deterioration in credit. That's when we start thinking about even pulling in the horns more on the equity side of the equation. We don't have clients that are way out on the limb from an aggressiveness standpoint, and we want to stay invested until we start to see some more cracks. And I think that credit quality is going to be the issue, where if we start seeing credit crack, that's when we have to take more drastic actions.
It's very much a signal.
Other than that, it's, hey, we knew there'd be volatility. This was our second 5% plus pullback for the year, and we're into the eighth month.
This is also, psychologically, this is also a good excuse for people. They can use this headline news as a reason to take profits.
Exactly, and we saw that yesterday too. So in general, we don't think the world's ending. We're going to stick with our game plan. It seems to be working through these bumps. We're going to stick with that. And like I said, we're really looking for, if there's changes, we start to see more deterioration, or if we start to see deterioration in the U.S. economy, that will cause us really from an allocation standpoint to change. But from a strategy standpoint, we're going to stick with what we're doing because, it's kind of worked the way we thought it would. And we like where we're at. We just don't think things are that bad in the U.S. economy. I think probably one resounding theme has been, from earnings expectation, everybody's expecting the worst, and things aren't as bad as everybody's expected. So we'll kind of see how things play out through this month.
When you set the bar low, it's easy to achieve.
Exactly, and by company basis, companies are finding out ways to continue to make money. Companies that do business in China, are looking at ways to kind of decouple a little bit from China, address that. But in the grand scheme of things, China has the world's largest second economy, but the largest population. At some point, we're going to have to work together, or it's not going to work out so well. I believe the U.S. is in a great position long term. China, I think things are going to change a lot over the next 10 years.
Yeah.
China will be different 10 years from now. The U.S. more the same, I believe, which is not a bad thing.
No.
We'll evolve, but still keep our same nature. I think China will continue to evolve and be something a little bit different 10 years from now. So.
They have to. This is very reminiscent of 1985, the Chernobyl days, when Mikhail Gorbachev came in and had perestroika and glasnost, and wanted to open up, and his people were demanding more freedoms. And you can only keep a population down, a people down, manipulate markets, misinformation. There's a natural trend that people desire freedom, and
right.
You've got to give the people what they want.
They've got a taste of it, so they're gonna evolve.
They are gonna evolve.
I think long term we're in a good shape, and these are issues that had to get addressed from a trade standpoint. So that's kind of the path we're going down. Keep your seatbelts on, and I think the strength, at least in the U.S., is there to get us through this.
Yep. And if you have any questions or concerns, as always, feel free to give us a call.
Thanks for joining us, and we'll be with you again in several weeks. If anything comes up in a short time, we'll do another video.
Absolutely. Thanks, everyone.
Thank you.